Welcome to This Explainer. Today, we're tearing right into Helen of Troy's Q1 Fiscal 2027 earnings report. We're going to go way beyond the standard, dry press release to uncover a pretty fascinating story here. Specifically, how a massive consumer products giant is pulling off a strategic pivot while navigating a really volatile global economy. To make this data-heavy report easy to digest, we've broken it down into a quick 5-part roadmap for you. We'll start with their house of brands, run through the Q1 financial scorecard, look at a tale of two segments, explore their new leadership and playbook, and finally, wrap up with navigating the road ahead. Let's get into it. All right, Chapter 1, the house of brands. Let's take a look at the familiar faces that make up this consumer products giant. Now, you might not immediately recognize the corporate name Helen of Troy, but I guarantee you know their products. They are literally the powerhouse operating behind the scenes of some incredibly massive, trusted household brands. We're talking OXO in your kitchen, Hydro Flask on your weekend hike, Vicks and Braun in the medicine cabinet, and Revlon or Drybar for your hair care. They're kind of everywhere you look. They take this hugely diversified house of brands and organize the whole empire into two main segments, beauty and wellness and home and outdoor. And this diversification is absolutely crucial. It acts like a giant strategic shield. If, say, beauty product sales dip one quarter, well, camping gear might be up, giving them this essential built-in balance. Moving right along to Chapter 2, the Q1 financial scorecard. Let's dive into the actual numbers for the quarter ended May 31, 2026. The big top-line number you absolutely need to know is $402.1 million. That's the consolidated net sales they brought in for the entire quarter. But what's really impressive here is what that number represents, an 8.2% consolidated sales growth year over year. Think about it. In a retail environment where a lot of companies are sweating just to stay flat, an 8.2% jump is no joke. Even management noted this came in ahead of their own expectations. But of course, here's the friction. Notice the gross profit margin. It actually dropped down to 46% from 47.1% this same time last year. Why the squeeze? Basically, it just costs a lot more to get these products onto the shelf right now. They got hit by unfavorable tariffs, shifts in what customers are choosing to buy, and inventory obsolescence, which, simply put, is taking a financial hit on older products that just aren't selling anymore. Now, to get a true read on their bottom line, we really have to look at earnings per share, and there is a massive discrepancy here. The reported GAAP earnings, the strict accounting rules, look amazing at $1.51. But the adjusted non-GAAP earnings, which strip out the weird one-time anomalies, are sitting at just 17 cents. So what on earth caused a gap that wide? Well, Helen of Troy recorded a $54.9 million pre-tax gain simply by selling off a distribution facility down in Mississippi. And hey, selling a warehouse makes for a fantastic quarter on paper, but it totally artificially inflates their core operating metrics. When you strip that windfall away, we're left with 17 cents. That gives us a much clearer, more honest picture of what the business itself is actually generating day to day. All right, Chapter 3, a tale of two segments. Let's break down that top-line growth and zoom in on those two main business engines we talked about. As I mentioned, the portfolio is split straight down the middle into home and outdoor and beauty and wellness. And the really great news for them this quarter, both of these distinct engines delivered positive growth. It wasn't just one side of the house dragging the other one across the finish line. And you can see that balance perfectly right here. Look how evenly matched they are. Home and outdoor pulled in $194.9 million, and beauty and wellness edged just slightly ahead at $207.2 million. So what drove home and outdoor to a really solid 9.5% jump? A few things. Strong international demand for their packs, brands like Osprey, and a nice boost from new product launches. But they also benefited from a bit of a historical illusion. Last year, tariff uncertainties caused retailers to shift their orders around, so comparing this year to that weird period naturally makes this year look a bit better. Meanwhile, on the beauty and wellness side, they posted a 7% growth. This was largely fueled by some new wellness product launches hitting the market, getting their nail care lines into more stores, and a very real-world rebound in fan and thermometer sales. Those specific items had really suffered previously from import cancellations, so it's good to see them bouncing back. That brings us to Chapter 4, New Leadership, New Playbook. You see, these financial results don't just exist in a vacuum. They're actually the first tangible proof points of a much bigger transformation story. So CEO G. Scott Uzel took the helm in late 2025, and he is executing a multi-year roadmap to get these brands moving again. He's laid out four main pillars, which pretty much boil down to this: focusing their cash on products that can actually win with consumers, holding their teams strictly accountable, getting super disciplined commercially by cutting the fat, and making their balance sheet work a lot harder for them. A real game changer in this new playbook, and something you should definitely keep your eye on, is the rollout of a brand new GM-led operating model. They are actively shifting to 5 segment general managers and 3 regional general managers. The idea is to bring the actual decision-making process much, much closer to the consumer, while establishing sharper, highly localized accountability. If something fails, they know exactly who to look at. And honestly, we're already seeing this discipline hit the balance sheet. They managed to shrink their inventory down to $467.4 million, which is a solid $17 million reduction year over year. But keeping a tighter leash on unsold goods, they actually improved their net leverage ratio. That means they have less debt relative to their earnings, which gives the whole company some much-needed financial breathing room. Finally, Chapter 5, Navigating the Road Ahead. With these early wins officially on the board for the new CEO, how exactly is Helen of Troy positioning itself for the rest of fiscal 2027? Well, management seems pretty confident. They officially updated and raised their annual sales outlook, now projecting up to $1.831 billion. All of this while maintaining their really strong profit expectations of up to $197 million in adjusted EBITDA. Essentially, they're expecting to generate enough extra cash this year to aggressively pay down their debt. But look, it is definitely not entirely smooth sailing. The report makes it very clear they have to cautiously navigate some severe headwinds. They're still facing sticky inflationary pressures and a general softening in what consumers are willing to spend on discretionary items. Throw in heightened geopolitical risks, unfavorable fluctuations with the Chinese yuan, and spiking freight costs, and yeah, it's a highly volatile macro environment for sure. So as we watch this turnaround unfold over the next few quarters, the critical question we're left with is this: with these clear, early signs of progress on the board, can Helen of Troy's disciplined new playbook actually outpace the friction of a tightening global economy? It's going to be a fascinating test of strategic execution against macroeconomic gravity. Thank you so much for joining me for this explainer, and definitely keep a close eye on how these brands perform in the months ahead.